On July 30th, 2025, Meta Platforms didn't just beat Wall Street's expectations, they obliterated them. Revenue surged 22% to a staggering $47.5 billion. Profits skyrocketed 38%. The Meta stock price jumped. On the surface, it was a perfect quarter, a flawless victory. But what if this incredible success is masking a catastrophic risk? What if the company is now so successful, so dominant, that it's become fragile? This isn't just a story about a great earnings report. This is a story about a $70 billion gamble, a hidden dependency that no one is talking about, and a stock price that is priced for a level of perfection that may be impossible to maintain. To understand what's really happening with Meta stock, you have to look past the revenue and focus on one number: capital expenditures. For 2025, Meta plans to spend between $66 and $72 billion. That's more than the entire GDP of some countries, and the vast majority of it is going to one place: artificial intelligence. This isn't just an investment, it's an act of economic warfare. Meta is in a brutal AI arms race with rivals like Google, who just raised their own spending plans. Meta is using the enormous profits from its advertising business to build a fortress of AI infrastructure, a capital moat so deep and wide that future competitors will find it impossible to cross. And it's already paying off. These AI investments are directly fueling the core business. AI-powered tools like Advantage Plus ad campaigns are making advertising on Facebook and Instagram more effective than ever, with some advertisers reporting a 22% improvement in returns. This AI-driven efficiency is why they crushed analyst expectations. But this fire hose of cash is funding two very different projects, and that's where the story gets complicated. We're about to connect the dots between Meta's AI spending and its secret metaverse plan that most analysts are missing. If you're getting value from this deep dive, hit that subscribe button right now so you don't miss our future analyses. There are really two Metas inside one company. First, there's the family of apps: Facebook, Instagram, WhatsApp. This is one of the most profitable enterprises in human history, generating over $20 billion in operating income in just 3 months. Then there's the other Meta, Reality Labs, the Metaverse division. This part of the company is a financial black hole. In the same 3 months, it lost an eye-watering $5.35 billion. That's over $58 million in losses every single day. Most analysts see these as two separate stories: a wildly successful ad business funding the CEO's expensive hobby. But this view misses the point entirely. It misses the Zuckerberg doctrine. In the earnings release, Mark Zuckerberg said, "I'm excited to build personal superintelligence for everyone in the world." This reveals the hidden strategic dependency. The massive AI investment and the bleeding Metaverse division are not separate bets. They are two halves of the same grand strategy. The AI is the brain, but Reality Labs is supposed to build the body, the AR and VR glasses that will house this new intelligence. The ultimate risk is that if the body fails, the brain has no unique home. The entire AI strategy is secretly being held hostage by the success or failure of the hardware. This high-stakes internal drama is playing out as storm clouds gather on the horizon. Two external threats largely ignored in the post-earnings euphoria could derail everything. First, the US-China trade war. Meta has no platforms in China, yet Chinese companies are one of its biggest sources of ad revenue. E-commerce giants like Shein and Temu spend billions advertising to the rest of the world on Instagram and Facebook. But escalating tariffs are forcing them to pull back. This geopolitical tension could cost Meta up to $7 billion in ad revenue this year alone. Second, the regulatory nightmare. In its own report, Meta warns of increasing legal and regulatory headwinds in the EU that could significantly impact our business. This isn't a distant threat, it's a clear and present danger to their business model. These are the unpriced risks. With 63 out of 71 analysts rating the stock a buy or strong buy, the market is acting as if the path forward is clear. But it's ignoring the geopolitical and regulatory storms that could easily capsize the ship. I'm about to give my final take on what this all means for the future of Meta stock. But first, I want to know what you think. Is Meta's AI spending a genius move or a reckless gamble? Let me know in the comments below. I'll be responding to the most insightful takes. So, what is the state of Meta stock today? It's a company performing a spectacular high-wire act. It is a financial powerhouse, printing money from its core advertising business. It's making a generation-defining bet on AI that could secure its dominance for decades. But it's walking this tightrope with no safety net. The market has priced it for perfection, leaving no room for error. It's carrying the dead weight of its metaverse gamble, and it's walking into the headwinds of a trade war and regulatory crackdowns. The question for investors is no longer whether Meta is a good company. The evidence shows it's a great company. The real question is whether it can be a perfect company, day in and day out. Because right now, that's what the stock price demands. To see how this story develops, make sure you're subscribed and have notifications turned on. Thanks for watching.